Hello everyone and welcome back to the Web3 Daily. Let's dive into the latest market dynamics. To be honest, the market sentiment over the past 24 hours hasn't been great. The entire board is flashing red, primarily spooked by two major macroeconomic factors. One is the looming threat of a US government shutdown over budget issues, and the other is the uncertainty surrounding the Federal Reserve's upcoming statements on interest rate policy. When this kind of uncertainty hits, risk assets are always the first to suffer. Data shows the total crypto market cap has shrunk by over 6% in a week, and the 24-hour trading volume has plummeted by nearly 27%, leaving the market sluggish. Bitcoin briefly dropped below 112,000, hitting a low near 108,800. Ethereum fared even worse, losing the $4,000 mark with a steeper decline than Bitcoin. The most dramatic part of this downturn was in the derivatives market, where over $400 million, some reports say as high as $1.5 billion in leveraged positions were wiped out, mostly long. This indicates the market was largely bullish and got caught completely off guard. So this decline has little to do with crypto-native issues. It's purely a case of being dragged down by the broader macro environment. It's a stark reminder that we shouldn't get too carried away with the decoupling narrative. In the grand chess game of the global economy, the crypto market is, for now, still a high-risk pawn. Alright, after that slightly tense market update, let's move on to the hottest topic on the web today. And this story is pure surrealism. The main characters are the decentralized derivatives exchange Hyperliquid and an NFT collection they airdropped called Hypurr. The whole thing started simply enough. The project wanted to thank and commemorate its most dedicated early supporters from the protocol's Genesis event back in November of 2024. So they decided to send them a little memento. Sounds pretty standard, right? But the market price of this memento, let me tell you, went beyond anyone's wildest imagination. Even before these NFT cats were officially distributed, prices on over-the-counter platforms were already skyrocketing, with some sales hitting as high as $88,000. And when the airdrop finally happened, the price just exploded. The floor price shot up to around $68,700. The most insane part, one of them, number 21, which had some super rare traits like Night Ghost armor, was sold for nearly 10,000 hype tokens. At a time, that was worth $467,000. Friends, $467,000 for a free cat picture. In many places, that's enough to buy a house. This just blew up the community. People who got the airdrop were celebrating wildly on Twitter, while those who didn't, or people outside the crypto space, were just left stunned. A Twitter user named Moon Overlord posted something that I think perfectly captured the mood. He said, "Crypto Twitter is really a special place in hell. The average person is struggling to get by or buy groceries, and you have people posting their $50,000 Hyperliquid cat NFTs they got for free. I think many of us can relate to that feeling. So why is a picture worth so much? To put it bluntly, nobody is trading the art itself. They're trading the intense expectation of its future benefits." The market widely believes that holding one of these NFTs isn't just about owning a collectible, it's like having a ticket to future wealth. It could mean additional token airdrops, perks from other new projects in the ecosystem, trading fee discounts, or even a share of the protocol's revenue. So, the price of this NFT is essentially the market's early valuation of Hyperliquid's future success. Looking at it from a deeper perspective, Hyperliquid played this brilliantly. They've upgraded the traditional airdrop model. With old-school airdrops of fungible tokens, many people would just dump them and leave, failing to build any real loyalty. But by airdropping these high-value NFTs, Hyperliquid has created not just a reward, but a status symbol, a certification of being in the inner circle. This NFT has become a golden shovel, and the market believes that if you hold it, you can continuously dig for gold in this ecosystem in the future. This makes the cost of selling the NFT extremely high for early users because you might be selling off a perpetual stream of future value. In terms of strengthening community cohesion and user loyalty, this strategy is far more effective than just handing out cash. Next up, let's talk about some major news in the Layer 1 space. This is about the future of Solana and could potentially shift the entire L1 landscape. The Firedancer team at Jump Crypto, the wizards building that high-performance validator client for Solana, just dropped a bombshell proposal. They're suggesting that after the big Alpenglow upgrade, Solana should just completely get rid of its fixed block size limit. What does that even mean? Simply put, it means the number of transactions a block can hold will no longer be hard-coded. Instead, it'll be determined by the most powerful validator on the network at any given time. They're calling this a performance flywheel. Well-funded nodes, wanting to earn more fees, will constantly upgrade their hardware to pack blocks bigger and bigger. Meanwhile, smaller nodes that can't keep up with the hardware demands won't be able to process these massive blocks, so they'll automatically skip voting, miss out on rewards, and eventually be forced to either upgrade or drop out. Sounds intense, right? It's like a never-ending hardware arms race, using market competition to force the entire network to evolve. But that's precisely where the problem lies. As soon as this proposal dropped, the community was divided. Supporters see it as a necessary step towards ultimate performance, a true survival of the fittest. But the opposition, including even the head of research at Anza, the company in charge of the Alpenglow upgrade, has warned that this could lead to a situation where only a few wealthy giants can afford to play. All the smaller independent nodes would be pushed out, leading straight to centralization. This would seriously undermine Solana's decentralized ethos and its censorship resistance. So you see, this is essentially Solana making a huge bet when faced with the blockchain trilemma. It's prioritizing scalability above all else, even at the cost of some decentralization. This is also a direct challenge to Ethereum's current path. Ethereum is going modular, with L1 for security and L2S for scaling. Solana, with Firedancer, is trying to prove that a single monolithic L1 can, through sheer optimization, achieve or even surpass the performance of an L2 combo. If they pull this off, it will be a massive disruption to the entire public chain landscape. Of course, the risks are just as significant. It all comes down to which narrative the market and the community will ultimately buy into. Alright, moving on from the deep tech talk, let's shift our focus to policy and regulation, which, let's be real, can sometimes make or break a project more than the tech itself. And this time, the spotlight is on the financial capital of the world, New York City. You've probably all heard of New York's so-called crypto mayor, Eric Adams. This guy has been a vocal champion for the space, a real advocate. Well, on September 28th, he suddenly announced he's out. He's suspending his re-election campaign. And he wasn't just talk. I remember when he first took office, he converted his first 3 paychecks into Bitcoin. That's a statement. He also publicly went after New York's notoriously strict bit license, calling it a killer of innovation. He hosted the city's first ever crypto summit, was planning a digital asset advisory council, and was even exploring using crypto for city payments and blockchain for things like birth certificates. He was basically rolling out the red carpet, telling the world that NYSE was open for Web3 business. So why the sudden exit? He's blaming the media for constant speculation and the campaign finance board for holding back millions in funding. Basically, no money, no campaign. This is a big deal. A friendly mayor is like a catalyst for the industry. With him gone, the future of Web3 policy in New York is completely up in the air. All those companies that set up shop there because of his friendly stance must be feeling pretty nervous right now. And that bit license? Adams was one of the few powerful voices challenging it. Now that he's stepping back, the future of the toughest crypto regulation in the country is a huge question mark. Whether New York can still compete with places like Miami for Web3 business is now a massive unknown. We've been talking more and more about institutional adoption, and that's a clear sign the crypto market is maturing. The latest milestone in this trend came on September 19th, when Grayscale Investments announced that its Grayscale CoinDesk Crypto 5 ETF, ticker GDLC, has officially started trading on the New York Stock Exchange. Now, this isn't just another Bitcoin ETF. GDLC is the first exchange-traded product in the US, market that lets you buy a whole basket of major crypto assets at once. Before this, if you wanted to invest in crypto, you either bought just Bitcoin, or you had to do your own research into all sorts of altcoins, which is both a hassle and high risk. With GDLC, it's like buying an S&P 500 index fund. You can instantly diversify your investment across the biggest and the most liquid top projects in the crypto market. Specifically, GDLC tracks an index called the CoinDesk 5 Index, which includes the Big 5, Bitcoin, Ether, XRP, Solana, and Cardano. Together, These 5 make up over 90% of the entire crypto market cap. Plus, the fund rebalances every quarter to ensure its holdings always reflect the current market landscape. In my view, the launch of GDLC signifies a shift in institutional investment logic from betting on a single asset to investing in the entire sector. This dramatically lowers the barrier to entry for traditional institutions. Think about pension funds or university endowments. They might be bullish on the future of blockchain, but don't want to gamble on the price swings of any single coin. Now, they can simply allocate a portion of their global portfolio to GDLC as a distinct asset class. This will bring a very stable and a long-term source of buying pressure into the market. Of course, this could also amplify the Matthew effect, where capital increasingly flows to the top projects, making the strong even stronger. Let's move on to some news about the accelerating convergence of traditional finance and DeFi. The global asset management giant Franklin Templeton announced on September 24th that it's expanding its tokenization platform called Benji to the BNB chain. They've already had a successful run with a tokenized US government money fund on Stellar and Polygon. Their choice of BNB chain this time is crystal clear. They're leveraging its high speed and low costs to bring a wider variety of real-world assets, or RWAs, as we often call them, on-chain for their global clients. There are 2 signals here that I think are particularly worth watching. First, the main character in the RWA narrative is changing. It used to be DeFi native protocols like MakerDAO leading the exploration, but now, with traditional giants like Franklin Templeton, who manage trillions of dollars, stepping into the ring, the scale and compliance of RWAs are about to enter a whole new league. This shows that RWA is no longer a niche DeFi experiment. It's becoming a core component of the modernization of global financial market infrastructure. Second, this raises the bar for competition among public chains. Why did Franklin Templeton choose BNB chain over the Ethereum mainnet? To put it bluntly, institutions can't tolerate Ethereum's high gas fees and sluggish speeds. So the future competition for public chains isn't just about attracting retail users, it's about winning over these super clients who control trillions in assets. Whichever chain can provide stable, cheap, and efficient services will get the biggest slice of the massive RWA pie. Finally, let's turn our attention to the stablecoin sector, which is seeing some major action again. A new network called Plasma just burst onto the scene, and in just 2 days after launch, its on-chain stablecoin supply shot past $7 billion. That speed is frankly a bit terrifying. So how did they pull off something so massive? It comes down to one simple, blunt, but incredibly effective feature: zero-fee USDT transfers on their chain. Think about it. For users in emerging markets where local currencies are unstable and there's a desperate need for US dollar assets as a store of value, how appealing is that? It's a perfect strike at their biggest pain point. Of course, to play at this level, you need some serious backing, and they have it. Plasma was created by the well-known crypto exchange Bitfinex, and Bitfinex is a sister company to Tether, the issuer of USDT. Suddenly, it all makes sense. This move is basically about keeping the family fortune within the family. The way I see it, this is a direct challenge to Tron. For years, Tron has become the main highway for USDT circulation thanks to its low transaction fees, and they've profited immensely from it. Now, it seems the Tether and the Bitfinex camp is no longer content with that arrangement. They've decided to build their own house, redirecting the immense traffic and network value generated by their own golden goose, USDT, away from third-party platforms like Tron and back into their own ecosystem. If Plasma can maintain its stability and grow, it's bound to take a huge chunk of Tron's market share. What's more, this forces competitors like Circle to respond in kind. Rumor has it, they're also planning their own dedicated payment chain. So, as you can see, the stablecoin war has evolved. It's no longer just a competition over which coin is more stable or user-friendly. It has escalated into an all-out war between the entire platform ecosystems that support these assets. Alright, that wraps up today's Web3 Daily. If you found this helpful, be sure to hit that like button to show your support. Every day, we sift through the Web3 world to bring you the most critical information, the news that's closest to the money. Our goal with these curated insights is to help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped exclusive registration links for major exchanges in the comments section below. We've secured these high rebate deals specifically for our viewers to help you save on costs as you invest. Let's all stay rational, move forward steadily, and get rich slowly together in the world of Web3. May all of your crypto assets grow steadily. We'll see you tomorrow.